Autumn Hofer, and I'm going to do a company analysis on Best Buy. I'm going to be reviewing the SWOT analysis, financial analysis, and some recommendations that I feel would better suit the company. So the overview is that they were found in August 1966 in Richfield, Minnesota, and incorporated in October of 1966. Their store offers things such as electronics, computing, and mobile phones, entertainment, appliances, and services. So some strengths of the Best Buy is financial performance. Due to strong revenue growth, Best Buy can provide higher returns to its shareholders. The brand loyalty and reputation, Best Buy is one of the first stops that consumers stop to buy large or small appliances, and they can also offer a competitive price. Their inventory ratio, they reported a ratio of 6.2 in 2018, and it takes Best Buy 59 days to turn over its inventory. They have multiple selling channels. They have 1,200 stores in the United States, over 200 in Canada, and 31 in Mexico, as well as an online platform, so customers can go into the store and buy, or they can buy online. They also have reliable support services, and it's called the Geek Squad, and I'm actually a subscriber of the Geek Squad, which is, it costs me $100 a year, but I can call in and they can remote into the computer to fix anything, to upload anything, download anything, and just repair anything internally on the computer. So it's a great service. Their weaknesses would be dependence of limited number of vendors and network carriers. Their main vendors are Apple, Sony, and Samsung, and there's no long-term contracts with them, so they could pull out anytime, and Best Buy would be in trouble because they'd have to find other vendors to find their or to get their products. They need some financial planning. Best Buy seems to be spending their cash more efficiently according to the current asset ratio and leading asset ratios, or liquid asset ratios. Poor product demand forecasting has them missing opportunities compared to their competitors. Also, high amounts of inventory are both in-house and in the channel due to the poor product forecasting. The opportunities would be the lower inflation rate, and the results of this brings more stability to the market, allowing credit at a lower interest rate for Best Buy customers. Their new customer from online channel, Best Buy has devoted a lot of their money into the platform, so this company can get to know their customer better by providing their needs using data analytics. Consistent free cash flow. With having more money in the bank, Best Buy can invest in their new technologies and new product segments and focus towards marketing strategies. They emphasize towards promotional campaigns that may benefit in reaching a diversified customer base. Their threats would be intense competition, new technologies being developed by the competitor, so they need to stay on top of new products and be aware of them. This I found interesting, the foreign exchange risk, that since Best Buy is in Canada and in Mexico, they have the current currencies control the US dollar. So in 2018, $76 million in US dollars was reported by Best Buy due to currency translation adjustments. Changing government policies would also be a threat to Best Buy. In their financial analysis, Best Buy's current ratio is over 1, meaning it has a good ratio between assets and liabilities. The quick ratio is well below 1 for Best Buy, so it isn't suitable for the special retail sector. Best Buy's portion of their assets is financed by equity, and the debt to equity is ranked higher than the 56% of the 744 companies in the global industry. One of the most crucial asset management ratios is the inventory turnover ratio. In 2008, the company reported a turnover rate of 6.2, and it takes, like I said, it takes Best Buy 59 days to sell their inventory, and a total asset turnover of 0.67, meaning that each of the dollar of assets generates 67 cents of sales, so the company is using its assets more effectively. The return on assets is higher for Best Buy than the industry, which implies that either the net income is higher than the average or the average total assets are lower than average. Best Buy ROE is higher than the industry. This means that the company invests more effectively than the standard special retail sector. Best Buy's price per earnings ratio is very comparable to the industry, so it proves that they are sticking with the industry. After looking at Best Buy's SWOT analysis, the firm needs to expand where they need to buy their merchandise or their vendors they do business with. Create contracts with long-term businesses with them. Top executives should look at where Best Buy is spending their cash and other financial planning programs for better spending. Implement demand forecast analysis for each store to avoid missed opportunity sales. Best Buy will need to evolve and adapt and find new ways to serve the customer and drive sales. Finally, the company needs to progressively boost its rate of top growth and create capabilities to help back investments and possible pressures to build more foreseeable revenue streams and a stronger customer relationships.